Good afternoon, guys. My name is Ben, ex-hedge fund manager and institutional trader and senior ITPM mentor. Happy New Year and welcome to this first Flash episode of 2024. The last time I did this was end of October, and I talked about how fear had really taken over as the primary driver for market action. So this led to a lot of otherwise fundamentally strong stocks becoming unnecessarily punished. And a lot of that is due to the emotional feedback loops that tend to happen when panic starts setting in. And a lot of that was generated primarily because of the unfolding geopolitical uncertainty happening in the Middle East at the time. So combined with continuous sticky inflation, high interest rates, and a Fed that had still not accepted that inflation had likely topped and that rate cuts could be, in the cards in the future. There was actually at the time they're still talking about potential for more rate hikes, but we know better. And since then, S&P is up 15%, Nasdaq is up 17%, and the small cap Russell is up over 20%. And a lot of individual stocks up a lot more than that if you know what to look for. So that's played out pretty much as we expected. Now the question is, what's in the cards for the first half of 2024? So since the top of the Russell 2000, which occurred in the summer of 2021, small cap stocks have really struggled overall. And for good reason. It's been an environment ruled by climbing inflation, rising interest rates, combined with sluggish economic growth. Plus, you add on the geopolitical uncertainty, not only in the Middle East, but also in Europe. But I believe this is about to change, setting the stage for revenge of the small caps. So I'm not talking about the really micro cap type of stocks here. Okay, more in the small to mid cap space, like 1 to 20 billion. So these stocks tend to have, many of these stocks will have options liquidity that is enough for us to execute efficiently, which can be an issue with small caps, but also be sensitive to these economical shifts and cycles. Okay, and the reason is they rely on debt much more than the bigger cap stocks. It's really their lifeline, and they use, most of these stocks need debt to operate and function and grow. Even if they might have negative earnings, positive revenue, but negative earnings. Cash flow could be an issue with many. So they need debt to, just to survive. And a lot of them actually didn't survive, but out of business. But because of this, when things start shifting, to the upside, they can really offer some massive potential. And it's been tough. It's been really tough. It's been kind of a perfect storm for this space. So what has changed recently for this to shift? Well, first of all, the big bad wolf here is inflation, climbing inflation, been the root to the problems for the most part. Now the CPI topped in September, and both October and November actually showed consecutive pullbacks for the first time in 12 months. And another measure of inflation that we look at closely is the PCE. Okay, this is a personal consumption expenditure index. It's something that I watch closely by the Fed and obviously ourselves. And in November, that reading came out actually declining 0.1% month over month, but coming in negative for the first time since February of 2022. So that's kind of a big deal. And the Fed has been really behind the ball in this whole rate cycle for sure. They were too slow to realize that inflation was an issue, and they're also potentially too slow to realize that inflation had topped. However, we're now finally seeing what has been obvious to us for a while. You have been paying attention. Inflation is, at least for now, in control. So the pivot of being open to rate cuts that the Fed talked about last meeting should not have been a big surprise. That said, the Fed minutes that actually came out this week show that there are continued uncertainty, really. So even though rate cuts are on the table, it's not necessarily a done deal. And biggest problem right now, really, or concern, is labor market. This labor market is still pretty tight. Okay, and that could lead to renewed inflationary pressures. But still, we now have a tilt more towards the dovish side, which is kind of the first thing we really need to see in order for this to take off. And we expected this to happen. Most large institutions expected this to happen, which is why the stock market rallied hard since November. Now, inflation pulling back, rate cuts on the table are the first ingredients for a potential rally, really, in small caps. However, we still need growth. So what's been going on with growth? So GDP growth for the US was 4.9% in the third quarter. That's the strongest since Q4 of 2021. So it puts the whole recession narrative kind of to bed. Granted, GDP growth is a lagging indicator. It's still, there's other stuff we look at to measure this as well. And something we do watch closely is NFIB, so the National Federation of Independent Business, Small Business Economic Survey. So this is a survey that we track quite closely, and the headline number came in at 90.6 for November, which that in itself, well, doesn't tell you much. But if you look deeper into the report, we can unfold some things that's been going on. And by the way, it looks like it's stabilized. You can see on this chart, it's kind of stabilized above 90. So as long as it doesn't drop really below that, there's a good chance that things will turn around. So anyway, if you look at the actual report itself, the biggest issue right now has been really a labor shortage. Not only a shortage, okay, but also it's a quality issue. They just can't find the quality of labor that they need. And that's clearly a big problem. However, if you read this report, you'll see that it is focused in the construction, manufacturing, and transportation sectors. So those are areas that I would avoid. 61% reported capital outlays in the last 6 months. So that's up 4 points from October. It's a pretty decent gain. And they also stated that a more positive view of the future economy combined with the economic policy will stimulate further longer-term investment spending. So rate cuts. So, if rate cuts starts really unfolding, which I think they will, then the gears, the gears of the whole economic machine will start moving again. And 63% said that they're not interested in a loan at the time. Remember, this was back last month. So that's attributed to high interest rates, clearly. But when interest rates come down, what do you think will happen to capital spending? And the economy overall. In fact, 22% of owners reported that inflation was their single most important problem in operating the business, combined with labor cost. Not really a big shock right there. So with inflation cooling off, the Fed rates coming back to earth, economic growth chugging along, not strong, but it's not terribly bad either. What are we looking for in a potential long idea in a small cap space? For smaller cap companies, it's all about revenue. Okay, sales. We need to see not only strong sales growth, but preferably increasingly strong sales growth. So we want to see exponential growth of the actual revenue growth itself. Now, what we're looking for are outliers that have fundamentally outperformed their peers on a fundamental basis, not only year over year, but also considering forward-looking estimates. And we need them to be in an exciting sector. Okay, we want to see a lot of room for expansion, growth, and just massive returns. That's what we're looking for. And options liquidity and implied volatility are also metrics that we consider. And there are simple ways actually to screen for all these elements. It's not honestly not that hard if you learn how to do it properly, which we teach you in our educational programs. And then timing is a big deal also, especially when trading options. So price action comes into play as well. Now, speaking of price action, IWM, which is the Russell 2000 ETF, has been in a trading range since Q1 of 2022. And after bouncing against this kind of pre-COVID high support level, it has now broken all three major pivot highs and is sitting near Q1 2022 levels. So it's been a pretty decent rally. Now, this first week of the year, we are seeing a pullback, not just in small caps, just overall in the market. Something I'm keeping an eye on. But look, that is usually attributed to tax advantageous profit taking by the big boys. So I would take the market action this first week with a grain of salt. So for now, I'm looking for long opportunities in high octane small cap names that have huge and explosive upside potential for the first half of the year. That said, though, this is still a stock pickers market. It's not like all small cap stocks are going to do well necessarily. There's still a lot of garbage out there in the rubble, and we need to be able to pick out the cream of the crop here. So that is a wrap for this episode. Keep an eye on those small caps. Be very selective. Okay, these stocks are not, they don't all move in sync. So you got to really pay attention to this. Catch you next time. Over and out.